Welcome to the Lesson 02 of Introduction to Financial Accounting. Before going to the lesson, do not forget to subscribe Accounts Tutor YouTube channel to get more videos like this. We learned what a business transaction means at the end of the first lesson. 5 results can be identified in a business transaction. They are as follows: assets, liabilities, equity, income, and expense. These 5 are important topics in financial accounting. Let's take them one by one and discuss further. Let's take the first one. It is asset. Assets in accounting refer to any resources owned or controlled by a business that provide economic value and are expected to generate future benefits. These are items or properties that a company can use to create wealth, improve operations, or pay off liabilities. Types of assets. Current assets. Resources that are expected to be converted into cash or used up within 1 year. Examples: cash, accounts receivable, inventory, prepaid expenses. Non-current assets. Long-term resources used in the operation of a business and not easily converted to cash. Examples: buildings, machinery, vehicles, patents, trademarks. Characteristics of an asset in accounting. 1. The entity has the right to control the asset. 2. The asset must have arisen from a past event. 3. The asset is expected to provide future economic benefits. 4. The asset must be a resource with measurable value. Liability. In accounting, a liability is a financial obligation or debt that a business owes to an external party, arising from past transactions or events. It represents a claim on the company's assets that must be settled in the future, typically through the payment of money, transfer of goods, or provision of services. Example: if a company borrows money from a bank, the loan amount is considered a liability until it is fully repaid. Types of liabilities. 1. Current liability. Short-term obligations are expected to be settled within 1 year or the operating cycle, whichever is longer. Examples: accounts payable. Amounts owed to suppliers for goods or services received on credit. Accrued expenses. Expenses incurred but not yet paid. It means salaries payable and interest payable. 2. Non-current liabilities. Long-term obligations not due within 1 year or the operating cycle. Examples: long-term loans. Borrowings repayable over multiple years, like bank loans and mortgages. Bonds payable. Debt securities issued by a company to investors. How to present liabilities in financial statements. Liabilities are categorized under the liabilities section of the balance sheet, divided into current and non-current based on their settlement period. Equity. Equity represents the ownership interest in a business. It is the residual value of assets remaining after all liabilities have been deducted. In simpler terms, equity is what the owners truly own in the business after settling all debts and obligations. The main key components of equity are as follows. 1. Capital contributions. The money or assets invested in the business by the owners or shareholders. For sole proprietors, this is called owner's capital. For corporations, this includes common stock and preferred stock. 2. Retained earnings. The accumulated profits that a company has earned and retained over time, after paying dividends to shareholders. Types of equity. Owner's equity. It may be a sole proprietorship or partnership that represents the owner's share in the business. Shareholders' equity. Corporation. The collective ownership stake of shareholders, including stock and retained earnings. Importance of equity. 1. Financial health. Indicates the net worth of a business. 2. Investor insight. Helps investors assess their returns and the company's growth potential. 3. Decision-making. Guides business owners in managing profits and reinvestments. Equity reflects the true value of ownership in a business and is a key metric in analyzing financial performance. Income. Income, also referred to as revenue or earnings, is the money or value a business earns from its operations and other activities. It represents the inflow of economic benefits that increase the owner's equity, usually through the sale of goods, provision of services, or other income-generating activities. Types of income in accounting. 1. Operating income. Income earned directly from the core business activities. Examples: revenue from sales of goods or services, consulting fees for professional services. 2. Non-operating income. Income earned from activities unrelated to the core operations. Example: interest income from bank deposits and dividend income from investments. 3. Other types of income, gain on sale of assets, unrealized income, and donations or grants. Income is a crucial indicator of financial health and a key metric for assessing a company's success and sustainability. Expense. An expense is the cost incurred by a business in the process of earning revenue. It represents the outflow of economic resources, such as cash or other assets, used to run operations and maintain the business. Expenses are recorded on the income statement and reduce the net income of a business. Types of expenses in accounting. 1. Operating expenses, costs incurred during regular business operations. Operating expenses can be further classified as administrative and selling expenses. Examples for administrative expenses are office rent, salaries, utilities, and supplies. Examples for selling expenses are advertising, marketing, and sales commissions. 2. Non-operating expenses, expenses not directly related to the core business activities. Examples: interest expense on loans or borrowings, losses from the sale of assets. Importance of expenses in accounting. 1. Measures profitability, helps determine the net income or loss of a business. 2. Resource allocation, identifies areas where costs can be controlled or reduced. 3. Compliance, necessary for accurate financial reporting and tax purposes. 4. Performance analysis, enables management to analyze the cost efficiency of operations. By categorizing and analyzing expenses, businesses can effectively manage their costs and improve profitability.